I'm not one of those who believes that the US dollar hegemony is going to end. I'm not one of those who believes that the gold is going to win the war against fiat currencies, the US dollar in particular. I am one who believes that gold, pardon me, and precious metals by extension, is going to lose the war less badly. As I had suggested to you before, my assumptions are fairly modest, which is to say that the market share of the stuff goes from 0.5% to 2%. Hardly an unusual outcome, given the magnitude of the problem.
RickRule, a seasoned investor and head of Rule Investment Media, has been actively advocating for gold as an investment option. He puts forth a compelling case, citing concerns surrounding the economy, escalating government debt, and the prevalence of negative interest rates. Rule urges investors to consider diverting their funds into reputable gold companies, positing that such investments could outperform other equities. In recent market movements, gold experienced a noteworthy 1% increase in value on a particular Friday. This boost was attributed, in part, to a weakened dollar. Additionally, the anticipation of a pause in U.S. interest rate hikes added to the allure of this precious metal. A significant point of contention for Rule centers on the mounting government debt in the United States, which has now reached nearly $33 trillion. For over 2 decades, the U.S. government has consistently spent more than it has collected in revenue, leading to the necessity of borrowing to cover the deficit. The national debt has swelled by over 89% since the onset of the pandemic. Although many prominent economists initially downplayed concerns about the debt in 2020, given the pressing public health crisis, attention has shifted back to how the ever-expanding debt could potentially harm the economy. Another concern highlighted by Rule pertains to the reliability of consumer price index data. He contends that the government manipulates this data, resulting in an inaccurate reflection of the true cost of living increases faced by the public. Officially reported, the CPI, which measures the cost of a wide range of goods and services, revealed a seasonally adjusted 0.6% increase for the month and a 3.7% rise compared to the previous year, according to the U.S. Department of Labor. Before you watch RickRule's interview, subscribe to our channel and give this video a big thumbs up.
If you have faith in government solutions, if you have faith in my president or your prime minister, if you have faith in your state and federal politics, then you probably don't need to own gold. For the rest of you, I'll address my remarks to you. Let's look at why the gold market may do well in the future. My own bias, of course, is that in my career, 50 years in the gold trade, gold has done well when people are concerned about the maintenance of the purchasing power of their savings denominated in conventional fiat savings products. And I think for the last 40 years, a period of declining nominal and interest rates, and a period of really amazingly balmy financial climates, that fear has been lost to people. One cause of concern for savers who are concerned about the maintenance of purchasing power in whatever fiat currency they choose to hold it in, Australian dollars or US dollars, might be concerned about what the big thinkers now call quantitative easing. Kerry, if you were quantitatively easing, if you were printing Stevensons and trying to buy them, that would be called counterfeiting, and you would be thrown in prison. If, however, you were a member of parliament, it would be highly popular with your constituents, and it would get you elected. Irrespective of the popularity of quantitative easing, what it really is counterfeiting. Making more of a specious currency unit with nothing to back it up does not increase the value of the existing specious currency units in circulation. Of more concern, of course, are government debt and deficits. I'll leave private debts to your own imagination. But in my country, I can't speak for Australia, but in the United States, the on-balance sheet liabilities of the federal government exceed $33 trillion. Another worry, and I suspect the thing that has American savers at least the most worried, is negative real interest rates. It is true that recently the purported inflation rate, the CPI, has declined. But I would suggest to the delegates at the conference that the CPI is itself another fraudulent government construct. In the first instance, the CPI is hedonistically adjusted, which is to say, if the big thinkers think that a stereo now has better physical properties than a stereo 20 years ago, and you pay more for it, that's a hedonistic adjustment. It doesn't actually cost you more. The thing that bothers me the most about the index, though, Carrie, is that the CPI doesn't include the cost of government. It doesn't include tax, as an example, or fees, which are, for most Australians and most Americans, the largest component of their household expense, greater, in fact, than shelter, transportation, food, and energy combined. A cost of living index that doesn't take into account the cost of government has got to be the silliest construct in the history of humankind. Carrie, as I've told you before, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. But that isn't on offer. So those people who are considering an investment in gold or gold-related securities, or those people who are concerned about the precious metals market, need ask themselves a question. Are they concerned about quantitative easing? Are they concerned about debt and deficits? And are they concerned about interest rates?
RickRule points out that in the United States, investments in precious metals account for less than 0.5% of all the money people save and invest. This relatively low allocation to precious metals is a notable observation in the investment landscape. According to a survey conducted by Gold IRA Guide, respondents who claimed ownership of precious metals leaned more towards silver than gold. Specifically, 11.6% of those surveyed stated they owned silver, while 10.8% mentioned owning gold. RickRule further underscores the gravity of the government debt situation by emphasizing that it extends beyond just federal debt. When considering state and local debts, along with various other types of debt, the problem becomes even more substantial. The increasing national debt is a concern that transcends political party lines, as both Democrats and Republicans acknowledge its unsustainable trajectory. Regardless of which party holds power, the debt burden continues to grow. The Congressional Budget Office projects that annual U.S. budget deficits could average approximately $2 trillion per year over the next decade. Let's get back to the video.
Precious metals and precious metals-related securities among the length and breadth of humanity are very, very underowned. In my own country, the ascribed market share of precious metals and precious metals-related investments relative to all other classes of savings and investment products is less than 0.5%, which is to say that less than 0.5% of all American savings and investment assets are precious metals related. JP Morgan Chase estimates that the 4-decade mean market share of precious metals in the U.S. savings and investment market is 2%. And I would suggest to the delegates of this fine conference that if savers and voters and investors in the United States consider quantitative easing, debt and deficits, and negative real interest rates, and they think of them as a possibility even rather than a probability, the market share of precious metals and precious metals-related assets in the United States, which, by the way, accounts for 23% of the world's savings and investment assets, migrates from its current 0.5% to the 4-decade mean of 2%. Were that to happen, and by the way, I think it's likely, demand for precious metals and precious metals-related assets would increase fourfold. And that's precisely what I personally believe is going to happen. Why hasn't it happened already? Well, I would ascribe it recency preference. Most people in the world regard themselves as sort of unbiased fact checkers. We believe that what we do is we import data and information from all sorts of sources, and we process that data rationally in our minds, and we draw rational conclusions. Except that's not what we do. Most people look through the world for information that supports their existing paradigms and preferences. And one of our preferences is not to be afraid. Another preference is to rely on other people, the government perhaps, to look after our financial future, to obviate, in fact, responsibility for ourselves going forward. Further, this recency bias that I described means that the lessons that we've learned over the last 40 years, that interest rates will go lower, that dominant currencies will remain dominant, that the economic bonus that we've got from the demographics of the last 40 years, and that one can buy the dip, have caused us not to be concerned or as concerned about the arithmetic around quantitative easing, debt and deficits, and negative real interest rates. By the way, the problem I described with regards to the federal debt in the United States doesn't include state and local debts, nor does it include underfunded private pensions, nor does it include individual or corporate debt, all of which are at very high levels relative to GDP on a historical basis. I'm, as an example, very glad about the circumstance that there has been a lagging expectation with regards to precious metals in the future. I consistently buy precious metals for my own account, and I am delighted that I have to use less money rather than more money to purchase those. I'm one of those who hopes actually that I'm wrong. I hope that the price of gold doesn't go up. Because if the price of gold doesn't go up, it means the set of circumstances that I so fear doesn't transpire. Because you see, I regard physical gold as insurance more than anything else.
In light of the compelling arguments put forth by RickRule regarding the merits of investing in gold, the concerns surrounding government debt, and the potential manipulation of consumer price index data, one might wonder, how should investors adapt their portfolios to address these economic challenges and opportunities? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.